Good afternoon, ladies and gentlemen. Welcome back to this weekly market review. Today is the 9th of September. We have completed the first week of September, and it's seasonality in focus. September has always been a bad month. So today I have with me, as usual, Mr. Gerald Wong to share with us some of the updates in the market. How are you, Gerald?
Hi, good afternoon, everyone. Very well. So I think we saw quite a bit of volatility in the markets to start off. We will share a bit about what are some of the things we are looking out for in the coming weeks, so as to understand what is the direction of the market going forward.
Okay, just a special mention here, Gerald Beansprout also was nominated for the SGX Op Awards. So I think we'd like to congratulate him here and look forward to more partnership with CIAS on sharing your research with us.
Thank you so much. Also, thank you everyone for your support in one way or another. I think it's been a great encouragement for us, and we look forward to pushing out more good insights and tools for investors in Singapore.
Hey, I'll let you go ahead with your sharing today, Gerald.
Okay, so today, 9th of September, as usual, we'll start with the disclaimers that the session is for information purposes only and should not be taken to be financial advice. We have an upcoming Ask SIAS on the 25th of September, Wednesday. This is free and exclusive for members of SIAS. So if you have got any questions for Sunny and myself, you can scan this QR code to register. And we look forward to your questions during the session. If you find our weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can go to this website, sias.org.sg/membership, or scan the QR code here. And as a member, you'll be able to attend various events like what we shared earlier, the upcoming ASIAS, as well as access various online resources, as well as investor education programs. Okay, this is the summary of the various key indices in the past week. You have noticed that the S&P 500 had a very significant fall of 4.2%. So this would make it actually one of the worst weeks in recent years. Okay. If you look at the performance of the Dow Jones and Nasdaq, what this is telling us is that the correction is very much driven by tech stocks, where we see that the tech-heavy Nasdaq index was down by 5.6%. Okay, I'm sure Sunny will be able to bring us through some of the technical indicators and let us know whether we are seeing some support levels or there could be some near-term further potential downside. But what actually surprised me was that the STI bucked the downward trend. We actually saw a slight gain for the STI with a 0.3% gain in the past week. What actually led to the fall in the markets, a big part of it was driven by renewed concerns about the health of the US economy. As we shared in the previous weekly market review, what we have been looking out for would be the US non-farm payroll data. And what we see here is that the August number actually disappointed investors once again, with 142,000 jobs added in the month of August, and that is below the market estimate of 160,000. The other worrying sign is that the July number was revised further downwards. So previously, we already shared that the July number was very weak. If you look at this, it was the weakest in quite a number of months. And with the further downward revision, what this has led to would be renewed investor concerns about the strength of the US labor market. So what are we expecting for the upcoming Federal Reserve meeting? It is just about 2 weeks away on the 18th of September. And based on the latest estimate, according to the CME FedWatch tool, investors are largely expecting that we'll see a 25 basis points rate cut. While the jobs data was weak, it was not weak enough for investors to increase their expectations of a 50 basis points rate cut. Okay, so this is where we are at in terms of the expectation, which is almost certainty of a rate cut, and we are looking at a 25 basis point rate cut. What also surprised me about this chart is that following the September meeting, investors are expecting two further 50 basis points rate cut in the November and December meeting, such that by the end of this year, we might be looking at the Fed benchmark rate being 1.25 percentage points lower than where it is today. Okay, so with the expectations of rate cuts and actually fairly swift rate cuts into the November and December meeting, we have seen quite a sharp fall in the US government bond yields. Last week, it went down to a 2-year low in terms of the US government bond yields, and we are at 3.71% now. Okay, so if you look at where it was just at the end of July, it was at about 4.3%. If you look at where it was actually in the second quarter of this year, it was actually close to 4.6%. So we have seen a very significant fall in US government bond yields just within the span of a few months. So what does this mean for the Singapore market? This is very clearly reflected in the STI top performers in the past week. We see quite a number of REITs actually being in the top STI performers in the past week, with Fraser's Logistics and Commercial Trust up by 3.7%, Mapletree Pan Asia Commercial Trust up by close to 3%, and likewise Mapletree Logistics Trust up by close to 3%. Okay, we also have CapitaLand Investment with a 3% gain, and we'll talk more about the transaction around the sale of ION Orchard later. Okay, if you look at the worst performers, we have got a number of the Jardine-related names here, including Hong Kong Land, DFI Retail Group, as well as Jardine Cycle and Carriage. Okay, I saw that CapitaLand Investment was one of the top gainers. If you look at the share price chart of CapitaLand Investment, in August, it touched a low of about 250 per share, and it's rebounded quite strongly since then, with the rising expectations of the rate cuts, as well as following the announcement of the divestment of ION Orchard. Okay, so closing at 279 on Friday, and that would make it one of the top gainers in the past week. Okay, likewise, we also see CICT, one of the very well-followed REITs in Singapore, having a significant bounce in its share price as well. Once again, this comes through from the expectations of the rate cuts, as well as the transaction that was announced. Okay, so what was announced is the acquisition of CICT of this 50% stake in ION Orchard, and the agreed property value that we see here, 3.7 billion Singapore dollars. Okay, so I think ION Orchard is probably not something that is unfamiliar for us in Singapore. Once you come out of Orchard MRT station, you will see it very prominently. Okay, so this is something that CapitaLand Integrated Commercial Trust has agreed to acquire. They are looking to acquire a 50% stake in this property. Okay. So what is the rationale for this transaction? First and foremost, as we can see, a lot of the traffic for ION Orchard is driven by tourists. Okay, so given that it is at a prime location at the Orchard Road belt, whether we see a further recovery in the tourist arrival numbers would also likewise affect the shopper traffic as well as the tenant sales at ION Orchard. So in terms of the expectations of the tourist arrivals, last year we saw a recovery in the tourist arrivals into Singapore at 13.6 million. Based on expectations of the Singapore Tourism Board this year, we are looking at a further recovery to 15 to 16.5 million for the full year. Okay, and based on the numbers that we have seen so far this year, they appear to be on track towards reaching those numbers. The key thing to keep a lookout for is that with the transaction, what CapitaLand Integrated Commercial Trust is looking to do is to still have a significant portion of its assets in Singapore, and at the same time remain fairly well diversified. Okay, so I believe that is one of the key reasons why many investors like CICT, and with the transaction, we see that the asset base is still fairly well split between retail, which will make up 35% of its portfolio from 30% currently. Office goes down slightly to 37% from 39% currently, and integrated development would make up 28% of its portfolio. Okay, with the completion of the acquisition, the total asset base will grow to 26.4 billion from 24.5 billion currently. Okay, if you're to look at the split of the retail assets, then what we see is that with the acquisition, the Orchard Road properties will increase from 14% to 25%. And with that, the downtown related retail assets will make up about 52% of its overall portfolio. If you look at suburban, then that becomes 48% currently, and then that will go down to 43% following the acquisition. Okay, and with the acquisition of ION Orchard, Singapore still remains the bulk of its portfolio at 94.2%. And what we see is that there are some remaining properties in Germany and Australia, but it continues to remain a Singapore-focused REIT. And as a result, it may be less subject to some of the fluctuations in regional currencies. Okay, in terms of the expectations for how this will impact its distributions, based on the forecast by the REIT manager, the acquisition will actually be able to grow its distribution per unit by about 0.9%. And this is the expectation in terms of how the acquisition can potentially change the distributions based on certain assumptions around how they are able to do the equity fundraising as well as the cost of debt. And if these are completed, the leverage ratio is expected to remain stable at about 40%. Okay, in terms of how the REIT manager intends to finance the acquisition, they have announced an equity fundraising to actually be able to help fund the acquisition. And this will amount to close to 1.1 billion Sing dollars, of which part of it will come through from a non-renounceable preferential offering, as well as a private placement. And with that, they will come up with the equity financing of the acquisition. Okay, so in terms of the timeline of the acquisition, it actually requires shareholder approval through an EGM. So the circular will actually be sent out shortly, and the shareholders can actually vote for the acquisition. And then thereafter, following the dispatch of the EGM circular, we have the EGM expected to be held sometime in late October or early November. And if the shareholders vote in favor of the acquisition fund equity fundraising is completed, then we are looking at potentially the completion of the acquisition in the fourth quarter of this year. Okay, so I've shared more about the acquisition of ION Orchard. What we have coming up in terms of key economic indicators to keep a lookout for. The last key data point that we'll be looking at before the Fed meeting is the US CPI data that will help us confirm whether the Fed is on track to cutting interest rates in the meeting next week. And whether we'll see a 25 basis point rate cut or a 50 basis point rate cut. For those investors in Singapore looking at the T-bill, there will be an upcoming auction on the 12th of September. And given the fall in the US government bond yields in recent weeks, investors will be keeping a lookout very closely as to whether we'll see a further decline in the 6-month Singapore T-bill bond yield. Okay, so with that, I'll hand over to Sunny, who will share with us the technical indicators.
Okay, thanks, Gerald, for the sharing on some of the movements in the Singapore markets. I just like to go through a bit more detail about the data that was released last Friday before we move into the charts, because that was to me is a mixed bag kind of a data. So Gerald actually touched on the non-farm payroll earlier. So the consensus was around 160 and the actual was 142. Yes, there's a miss, and then according to Gerald charts earlier on, which was extracted from this website, you can see that the non-farm payroll numbers actually increased for the August period. So that's not a really worrying sign for me, because I see it as it could be a rebound happening. And there was also a reduction in the July numbers as well. So that's more or less spooked the market a bit, and hence may explain the big pullback on that we saw on Friday. But I believe some of the investors may miss the data that the unemployment rate, which was previously at 4.3%, actually went down to 4.2% in line with expectation. That means that the economy is not doing too bad, because unemployment rate is actually slightly coming downwards. So that could also be the reason why the CME Fed Watch 2 signal that in the September rate cut, right, that we are expecting later this month, is now hovering around the 67% or 70% probability numbers. So before the non-farm payroll data that came out on Friday evening, I was actually asked by a few of our CIAS members, and of course on the radio show that we have on Money FM. Before that data, the reading on the CME Fed Watch 2 was around 50-50, between a 50 basis point cut and a 25 basis point cut. And after the data, it went to 70 for a 25 basis point cut. That also signals to me, in my own opinion, that, hey, the job market is not as bad as what market is expecting. Hence, I could not also reconcile the pullback on Friday. And I'm still in the opinion that a soft landing is still highly possible for this going ahead, as the Fed managed to reduce the interest rate and then watch the inflation levels. So we talk about 50 basis point cut in November and December. Pardon me for repeating this. We are, as the Fed say, we are always data dependent on the rate cuts to see what happens going forward. So the probability that we see in November and December cuts, right, may still change quite a bit, just like what we saw last Friday. So this could be an indication for now, but you need to watch closely of how the probability change as well with the data that's coming up, with the first one, the CPI data coming up this week. Okay, so trying to make sense of this data, let's move to the charts. I think I will start with the US charts first. So you can see that the Dow Jones Index actually dropped about 1% last Friday, and for the week, it dropped quite a bit as well. So we started September on a shorter trading week, because last Monday was a US Labor Day holiday. So some of them, as usual, when trading weeks become shorter, there's a lot of crowded trade. People try to squeeze all their trades into a 4-day period. Hence, you can see the steep pullback over here. So we are now going to be testing the blue line, which is the 50 days exponential moving average. That is around the 40,239 points level. So if looking at the indicators, you can see that the RSI has turned bearish, because it crossed below the 50-point neutral mark. The MACD has also had a crossover last week, where the MACD crossed below the signal line. Hence, we got a negative MACD histogram reading. Okay, so the charts is what will help us to understand what is the sentiment or the psychology in the market right now. So we have a bit of a fearful behavior now in the market, and hence we had a pullback. So like what I said earlier, I felt that the data come out may not signal that we are going into a recession or something, a hard landing. I'm still in the opinion of soft landing. So like what we saw in the early part of August, where we tested the amber line here, which is the 100 days moving average, that will come in again to become a very strong support. And this pullback, if it hits the 100 days moving average at 39,658 points, would be a strong support level for the Dow Jones Index yet again, as we've seen earlier in the August period. Okay, next let's move to the S&P 500, which is impacted more than the Dow Jones Index, because of the rotation out of the mega tech stocks as well as the risk asset. So we have already put back about 1.73% last Friday, and for the week we have put back much more. Just let me take a look at that reading again. For the week we have put back about 4.25%, which is what Gerald shared earlier. So we are approaching the 100 days moving average, the amber line here, which is at 5,379 points now. So that is the next support level. Whether this 100-point moving average will hold, based on the previous experience that we've seen in August, it has been tested quite deep. In fact, we are closing into the 200 days moving average. So I would say for the S&P 500, if you are thinking that this is an opportunity to get back in, I think you would have to wait for it to go under the 5,379 points mark, which is the 100 days moving average, somewhere between the 200 days moving average and the 100 days moving average. If you average out your trades over here, you could be quite safe in that zone. Of course, you would also need to monitor the indicator as well, whether there's any signs of a rebound coming in. That would also help you time the market better on when likely a rebound will happen in the S&P 500. But based on the indicators right now, I'm seeing a negative MACD reading and a RSI reading that's below the 50-point neutral mark, not yet hitting the 30-point oversold mark yet. So as of now, there is no sign of a rebound until we see further indication of a sort of a slightly neutral reading, at least on the MACD indicator, and the RSI either crossing above the 50-point neutral mark, which means that momentum is starting to get back, or we go into the 30-point oversold level, and thereby it could become a oversold signal, and hence a technical rebound could happen. Okay, so S&P 500 KIV, we will update you next week as well as to whether we will see a rebound kind of indication coming in for the S&P 500 index. Lastly, the Nasdaq Composite Index, which is the tech-heavy index, needless to say, suffered the worst drop, okay, since 2020, if I remember, okay. This week drop, last week drop, I would say the first September week drop was at 5.77%, and last Friday it dropped 2.55%. So this drop is one of the biggest drop in the past few years, and you can see as of last month, you can see that the Nasdaq Composite Index actually dropped all the way to reaching the 200 days moving average before having a very strong rebound. So looking at the indicators momentum right now, we can see that it's negative on the MACD, it's much more negative on the RSI, and we are 7 points away from the oversold level of 30 points on the RSI reading for the Nasdaq Composite Index. So the previous time we saw that the RSI tested the 30-point level was around the April period, and then we have a sustained uptrend again. Okay, so if let's say we will test that level again, the 30-point level in the RSI indicator, that could signal that we have gone into a oversold situation and a technical rebound could happen, and that could definitely be around the level of the 200 days exponential moving average, which is now reading at 16,300 points level. So you can see that it was tested quite deeply in the August period. So this time round, I would also say that yes, it might test this 200 days moving average and might go slightly deeper. And if I may change the exponential moving average to a simple moving average, okay? So the red line is over here. You can see that according to the simple moving average, we still have quite a bit to go into the 16,276 point level. That could be the area where the Nasdaq could have a rebound, a very strong rebound at the long-term moving average, okay? So I'll switch it back now. I will just round off the numbers. So 16,300 points will be the support for the Nasdaq Composite Index to look for a possible technical rebound over here. And anything else beyond that, we will have to look further into the data that's coming out to see where the rate cut probabilities will be, and hence how the market will react from there. Lastly, before I end off today's session, let's look at the STI index. I would say it's very commendable for STI performance. As Gerald shared earlier, you can see that among the 3 US indices is all negative last week, but STI was in the green. This morning wasn't a surprise as well. You can see that Dow Jones in the red last week, but STI managed close to a 0.5% gain, okay, in early Monday morning trade. So that means that whenever there is sort of a storm or there's a lot of volatility in the overseas market, in the US market, investors tend to seek a safe harbor. And Singapore stocks, especially the REITs, could be a safe harbor because of their high yield kind of characteristics, and that could see some funds flowing back into the Singapore market. Okay, So looking at the STI, we are positive today. And according to the MACD indicator, we still have a positive reading. But of course, that uptrend since the pullback that we saw in early part of August is starting to subside a little bit, but it does not seem like it's going to have a sharp turn downwards anytime soon. So I believe it will crawl and that crawl upwards slightly slower. And it's still a possibility that we could retest the high that we saw somewhere in the July period at 3,509 points. But I do not think we would have a breakout anytime soon because momentum is residing. So we could test that level, but I don't think a breakout will occur at this point. So you have to manage your risk and reward ratio if you're looking at the STI index. The RSI reading on the STI is very, very healthy at the 63 points level, seven points away from the overbought level of 70. So do take note when it hits that level, that is an indication that some strong selling will come in and the resistance will start to form. And if this theory of mine is correct, then the resistance of 3,509 points in the July period could be the resistance level that you should be watching out for if you are thinking of getting into the STI index. Okay, so this are the sharing that I have for this week. Anything else that we need to add, Gerald?
Yes, I think it is quite amazing that this morning the STI continued to see gains, while we see all the regional markets as well as the US markets having fairly sharp corrections over the past few days. Okay, so I think with that, we'll be looking out very closely for the US Consumer Price Index data. That will be one of the major data points that investors will be looking out for before we go into the Federal Reserve meeting next week. As to whether we'll finally see the first rate cut coming through, I think that is what all investors are looking out very closely for, and we hope to be able to provide you with that update during next week's weekly market review.
Yes, thank you, Gerald. So if you want to stay updated to the latest market movement, do remember to like, share, and subscribe to our socials on SIAS. And of course, I'd like to thank Gerald and all of you today for joining us. And we'll see you again next week in the next weekly market review.
Thank you.
Bye-bye.